In today's video, I'm going to be talking about the Bank of Canada's decision to decrease interest rates from 5% to 4.75%, what happened, why it happened, and the impact for you as a Canadian borrow, saver, or investor. So let's get right into it. So first of all, the big announcement that came out this morning was that the bank was dropping their overnight or their policy lending rate from 5% to 4.75%. So that's a decline of 0.25%. It's not huge, but it's a decline nonetheless. And so that's kind of the big news. And so all the things that are impacted by interest rates are largely affected today because this is the first time in 4 years that rates have actually gone down as opposed to staying flat or going up. That doesn't mean that rates are the lowest they've ever been in 4 years. No, it's about the same as it was this time last year. So the bank said that their reasoning is based on the fact that the economy was growing a little bit slower than anticipated. Inflation is coming down kind of in line with what their expectations were. And as such, they don't have to have such restrictive monetary policy. Again, we say the term restrictive because when interest rates are high, that means that people are less willing to spend because it costs too much to borrow. And so it's restrictive on the economy, and that's done to kind of tame inflation. So when rates come down even a little bit, the incentive just at the marginal level does go up for people to borrow a bit more money and then hopefully spend a little bit more and stimulate the economy. Now, the risk there is that prices then go up again because too many people are buying and inflation kind of kicks in again. The fear that I've been seeing online is largely due to home buyers and the fear that the decline in borrowing cost will actually introduce more people into the housing market. And so this decline of 0.25% isn't huge, and it's probably not going to move the needle that much to really get a whole bunch of new buyers in the housing market, but you never know. So that is a risk, and they're aware of that, and that was in their policy statement today. It's just something that they're kind of keeping an eye on. So how will this affect you as a borrower, as a saver, and an investor? So borrowing is kind of the big one, and kind of touched on it already. But usually when you borrow money in Canada, it's tied to something called the prime rate. And the prime rate is actually set by consumer banks, not the actual Bank of Canada, which is our central bank. They're tied closely, and it's probably going to happen. I think I've already seen an announcement from TD that they're reducing their prime rate already. But the prime rate is just like the general rate that they're going to lend money out at. And things like variable rate mortgages and lines of credit and things like that are plus or minus the prime rate in some way or another, but that's just kind of like the standard. So when the Bank of Canada reduces their interest rates, that means the consumer banks like TD and RBC, their cost to borrow money goes down. And so then they pass that on kind of down the line and they reduce their prime rate accordingly. So for things like variable rate mortgages, if your bank reduces their prime rate, then you will see a reduction in the cost of your mortgage because your interest rate will then decline. If for whatever reason your bank takes a long time to reduce their rate, then you won't see that decline in cost until they do that. But I suspect that most of the banks will fall in line pretty quickly here, but that's just kind of what you can expect. It's not going to be instantaneous unless your bank acts very, very quickly. For things like fixed rate products like mortgages, so I've seen some people online say like, oh, well, I just signed my 5-year fixed mortgage yesterday. Well, thank you very much. 5-year fixed mortgages are not tied directly to instantaneous policy changes like this one would be. They're more closely tied to the 5-year government bond. If it's a 3-year mortgage, it'd be a 3-year bond, things like that. Because mortgage lenders will tie their debt to very secure things like the debt of the country. So the 5-year bond and all other bonds, they trade on the open market. And so what that means is that the price that they trade for largely has information baked into it already, and that information is speculation on what's going to happen with interest rates. So because this has kind of been anticipated for the last at least a week, but probably the last month or so, that's probably going to happen here. Yields on the 5-year government bond have actually started to come down. And you can see in the chart I'll put up on the screen here that in the last week or so, they've come down steadily to kind of match where they are today. So it's not necessarily the case that the day that interest rates drop from the Bank of Canada, that fixed rate mortgages are going to go in lockstep with that. No, it's probably baked into it already, and perhaps many mortgage lenders have already decreased their lending rates accordingly with the corresponding yields in the 5-year bond. For people who are saving money, so using things like money market funds or parking it in high yield savings accounts and things like that, it is very likely that the yields on those accounts will now decline as well. So that's kind of the other side of the coin of high interest rates, right, is the ability to actually lend money out and make some money. But when the rates come down, you don't get paid as much to park your cash. So for savers, so people just saving cash, the benefit of doing that decreased slightly today. It's probably not going to move the needle between it was a good decision yesterday, it's a bad decision today, or anything like that. It's just marginally worse for you as a saver. On the investing side of things, investing takes so many variables into account that it's tough to nail down one specific thing, but I'm just going to talk about currency. And currency is something that does have a connection to prevailing interest rates. Again, these things are anticipated, so the market does incorporate new information or anticipated information into the price. And then when something is actually announced, sometimes there'll be like a specific move that happens before things kind of rectify or come back to where the market thought they should be in the first place. And so we saw that today already. So when the announcement happened, there was a bit of a blip in the value of the Canadian dollar versus the US dollar. And then throughout the day, then traders kind of even things out and it kind of fills the gap. And so you can see that on the chart that I'm going to have up on the screen here is 2 ETFs for the S&P 500. One is Canadian listed in Canadian dollars. The other one is US listed in US dollars. And you can see right at the beginning, there's a big jump that happens on the Canadian dollar listed one. And then as the day kind of goes and the currency moves kind of evened out by the end of the day, they ended up almost identically at the end of this day. Today was a pretty positive day for the US stock market, but you can see that the currency gap there largely got filled over the course of the day. So I don't anticipate that this one move will have a significant effect over values of the Canadian dollar. But if the bank decides to continue dropping rates and the US either stays flat or for whatever reason increases their rates, it goes the opposite direction, you could probably see a meaningful discrepancy between the currencies if those changes continue to happen at the monetary policy level. So again, if the Bank of Canada continues to drop rates, but the US kind of stays the same, the little blips that you see here will probably become larger, and there would probably be a corresponding decline in the value of the Canadian dollar relative to the US dollar. So to kind of say the things that are unsaid there, when the Canadian dollar decreases in value, if you as a Canadian dollar investor own foreign property, so US stocks in US dollars, then the relative value of those stocks will actually go up a little bit more. So you can kind of see that on the previous chart where you saw that that increase in the value of the Canadian listed one because the value of the currency declined. So if the currency really tanks over the next few months, but you own US stocks, the value of those will probably go up. So as an investor, there'll be some marginal benefit there, maybe, but largely speaking, currency stuff as it relates to investing is kind of a wash, but there is some marginal impact day to day. So that's just a quick summary of the things that happened today. Again, it was a decrease in the policy rate or the overnight lending rate from the Bank of Canada from 5% down to 4.75%. So if you're a borrower with variable rate debt, your cost of borrowing just decreased, or when the prime rate changes, it'll decrease a little bit. If you're looking to get into the housing market, who knows, you might now be fighting with a few more people who are looking to buy a house with cheaper debt. So that could be a problem there. If you have money market funds or you have a cash like high interest savings account type ETF or things like that, your yields on those products probably will decline. But you've probably seen that over the last few weeks anyways, as the market anticipated these big changes. And then the currency, same thing there. It's an open market on currency. For Canadian dollars and US dollars anyways. And so as the market anticipates changes like this, they'll broadly get baked into prices over a longer period of time. So the instantaneous decision today to decrease that rate won't have as many immediate impacts. in the currency world or in the fixed rate mortgage world, but mostly just on things like variable rate debt when the prime rate does drop by that 0.25%. So let me wrap up this video by introducing myself. Hi, I'm Evan Neufeld. I'm a certified financial planner based out of Saskatoon. And here on YouTube, I make content for pre-retirees or people that are looking to retire in the next 5 to 10 years or so. So if that's you, welcome here. And you can subscribe or check out my channel for more content that's relevant for people in your situation. So if you made it this far, thank you so much for watching this video, and I hope to catch you on another one sometime soon.